In today's video, we are doing a deep dive into IT services accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. IT services companies like TechWave Solutions provide technological support and solutions to businesses across various industries. This sector has seen exponential growth due to digital transformation needs. Major players include Accenture, Infosys, and IBM. In India, the IT services industry is a key economic driver, contributing significantly to GDP and employment. Companies in this industry offer consulting, managed services, and custom software development. TechWave Solutions generates revenue primarily through service contracts, custom software development, and consulting fees. The model emphasizes long-term client relationships, ensuring steady cash flows. Major cost drivers include labor, technology infrastructure, and compliance. By leveraging skilled labor and advanced tech platforms, TechWave effectively manages costs while maintaining high service standards. Understanding this model helps in crafting accurate financial projections and risk assessments. In an IT services firm like a TechWave, departments such as finance, operations, procurement, and legal play pivotal roles in accounting. Finance manages budgets and forecasts, ensuring liquidity. Operations handle project-related costs and billing. Procurement deals with vendor contracts and technology purchases, while legal ensures compliance with regulations and contract law. Each department's role ensures the company's financial health and regulatory compliance, vital for sustainable growth. The workflow in IT services at TechWave involves several key steps: client engagement, requirement analysis, solution design, implementation, testing, and deployment. This sequence ensures that client needs are thoroughly understood and addressed with tailored solutions. Each step incorporates feedback loops and quality checks, ensuring high standards and client satisfaction. Effective workflow management is crucial in minimizing delays and maximizing resource utilization. Key stakeholders in IT services include clients, vendors, government, banks, and regulators. Clients drive revenue and define demand for services, affecting cash flows and strategic direction. Vendors supply essential technologies and services, impacting cost structures. Government and regulators enforce compliance, requiring transparent financial reporting. Banks facilitate funding and liquidity management. Each stakeholder group has distinct accounting implications, influencing financial planning, risk management, and operational strategy. Accounting in IT services faces challenges such as managing the working capital cycle, handling complex contracts, and adhering to regulatory requirements. The working capital cycle is influenced by project billing and collection timelines. Contract complexities arise from diverse client needs and service-level agreements. Regulatory compliance requires stringent financial controls and reporting standards. These challenges necessitate robust financial planning and risk management strategies to maintain operational efficiency and competitiveness. Accounting in IT services differs from generic businesses due to revenue recognition complexities and project-based accounting. Revenue is often recognized based on project milestones, impacting financial statements and tax obligations. Additionally, the intangible nature of services requires careful valuation and cost allocation. These unique aspects necessitate specialized accounting practices and systems that can handle the intricacies of IT service delivery, ensuring accurate financial reporting and compliance. In IT services, accounting entries are typically passed by the finance team upon certain triggers, such as project completion or invoicing. The finance team ensures entries reflect accurate revenue recognition and cost allocations. These triggers align with project milestones or contractual obligations, ensuring timely and accurate financial reporting. Understanding who passes these entries and why is crucial for maintaining the integrity of financial records and supporting strategic decision-making. In IT services, understanding the end-to-end accounting process is crucial for managing project finances effectively. This section breaks down each step in the transaction lifecycle, from the initial request for service through to final payment and reconciliation. By mastering these processes, TechWave Solutions can ensure accurate financial reporting, maintain compliance, and enhance profitability in a competitive market. The accounting journey begins with a service requisition, initiated by the sales department at TechWave Solutions. This step involves drafting a service order based on client requirements. The client sends a request for proposal, RFP, and TechWave responds with a proposal, detailing services and costs. If this step is not handled correctly, there is a risk of scope misalignment leading to client dissatisfaction. Once a proposal is submitted, the client's procurement team reviews and approves it. This involves checking the proposal against their budget and project needs. Approval triggers an internal review process at TechWave, where department heads ensure that resources are available. Delays or errors here can lead to contractual issues or resource shortages later in the project. After approval, a contract is signed, and a purchase order, or PO, is issued. The legal team drafts the contract, ensuring all terms are clear. The PO acts as a formal request for services, triggering entries in the accounting system. Inaccurate contract terms, or PO details, can cause billing disputes or compliance issues. In many cases, an advance payment is required to initiate the project. The finance department at TechWave invoices the client for this advance, leading to an entry in accounts receivable. This step ensures initial funding and commitment from the client. Mismanagement here, such as incorrect billing, can disrupt cash flow and project timelines. Upon project initiation, TechWave delivers initial services. The project management team oversees this delivery, using systems like ERP to track progress. The receipt of services by the client triggers a recognition of revenue in accounting. Errors in tracking can lead to misreported revenue and client dissatisfaction. As services are rendered, costs accumulate in a work-in-progress WIP account. The project management team tracks time and resources, updating the WIP account accordingly. Accurate tracking is vital for maintaining profitability. If data is mishandled, it could lead to discrepancies in project cost reporting and financial statements. Upon project completion, a final review ensures all deliverables meet client expectations. The completion is certified, and any remaining balance is invoiced. This step involves the project management and finance teams verifying deliverables. Misalignments here can lead to disputes or payment delays, affecting cash flow and client relations. After project completion, the final invoice is issued to the client. The finance team ensures all costs are captured and terms are consistent with the contract. This invoice reflects the total amount due. Errors in invoicing can lead to payment disputes, affecting cash flow and client satisfaction. Once the client pays the invoice, the finance team records the payment, closing the accounts receivable entry. Reconciliation ensures all records match, highlighting any discrepancies. This final step is critical for accurate financial reporting and maintaining client trust. Failure to reconcile can result in financial inaccuracies and potential audit issues. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition is crucial in IT services, as it determines when a company like TechWave Solutions can record its earnings. Due to the prevalence of long-term contracts and milestone-based payments in the IT industry, determining the right moment for revenue recognition is essential. This concept is governed by Indian Accounting Standard 115/International Financial Reporting Standards 15, which outlines that revenue should be recognized when performance obligations are satisfied, typically at the completion of a contract phase. For example, if TechWave delivers a software module, revenue is recognized once the module meets client specifications. Unlike general accounting, where revenue might be recognized at the point of sale, IT requires careful tracking of project milestones, ensuring accuracy in financial reporting. Contract accounting involves managing work in progress, which is especially significant for IT companies dealing with large-scale projects. For instance, TechWave Solutions must monitor the costs incurred and completion status of ongoing contracts. Under International Financial Reporting Standards 15 and ASC 606, Revenue and costs must be matched to the progress of contract fulfillment, ensuring expenses and revenues are recognized appropriately. This approach ensures that financial statements accurately reflect project stages, unlike general accounting, which may not require such detailed tracking. For IT services, this means regularly updating contract progress to maintain financial accuracy and transparency. Deferred revenue is an accounting concept where payments received before service delivery are recorded as liabilities. In IT services, especially with subscription models, this is common. TechWave Solutions might receive payment for a year-long software service upfront, but can only recognize revenue as the service is delivered. Following Indian Accounting Standard 115, International Financial Reporting Standards 15, this ensures revenue recognition aligns with service performance. This differs from general accounting, where immediate revenue recognition might overlook future service obligations. For IT firms, managing deferred revenue ensures financial statements reflect true service delivery timelines. Fixed assets in IT include significant investments in hardware and infrastructure. Managing these assets is crucial for a company like TechWave Solutions, which relies on state-of-the-art technology. Indian Accounting Standard 16, IAS 16, provides guidelines on recognizing, measuring, and depreciating these assets. Depreciation reflects the gradual wear and usage over time, matching asset costs with revenue generated. For example, a server's cost is spread over its useful life, ensuring expenses align with usage. Unlike general accounting, IT requires faster depreciation schedules due to rapid technology changes, impacting financial planning and asset management. Lease accounting involves recognizing leased IT equipment as assets and liabilities on the balance sheet. For IT companies like TechWave Solutions, leasing high-value tech equipment is common. Under Indian Accounting Standard 116/International Financial Reporting Standards 16, lessees must recognize right-of-use assets and corresponding lease liabilities, reflecting the cost and obligation of leased assets. This differs from traditional methods where leases might not appear on balance sheets, potentially underreporting financial obligations. In IT, accurate lease accounting ensures transparency and better financial management, especially with costly, rapid technology upgrades. Cost allocation involves distributing expenses among IT projects accurately. For companies like TechWave Solutions, determining the cost of each project component is crucial. Cost accounting principles guide this process, ensuring that every expense is allocated to the right project, facilitating precise profitability analysis. For example, allocating developer salaries to the specific projects they work on helps in understanding project profitability. Unlike general accounting, IT requires detailed tracking of individual project costs, impacting pricing strategies and financial forecasting. Effective cost allocation is vital for maximizing profitability and resource efficiency in the IT sector. Foreign currency transactions are crucial for IT services companies like TechWave Solutions, which often deal with international clients. These transactions require converting foreign currency into the company's reporting currency, guided by Indian Accounting Standard 21, or IAS 21. This standard emphasizes using exchange rates at the transaction date and adjusting for rate changes over time. For instance, payments from a European client must be translated from euros to local currency, considering exchange rate fluctuations. Unlike general accounting, IT companies often face complex currency translations due to global operations, impacting financial statements and profitability. Provisions and contingencies are essential for managing potential liabilities in IT projects. For a company like TechWave Solutions, anticipating risks in contracts is critical. Indian Accounting Standard 37, IAS 37, provides guidelines for recognizing and measuring provisions, which reflect probable obligations arising from past events. For example, setting aside funds for potential project delays or penalties ensures preparedness for future outcomes. This contrasts with general accounting, where such detailed anticipation might be less common. In IT services, managing these contingencies ensures financial stability and risk management, crucial for maintaining client trust and project continuity. Segment reporting involves breaking down financial performance by specific service lines within an IT company. For TechWave Solutions, which may offer various services like software development, cloud solutions, and consulting, segment reporting is essential for understanding the profitability of each segment. Indian Accounting Standard 108 and International Financial Reporting Standards 8 mandate reporting revenue and performance by segments, providing stakeholders with transparency into how each area contributes to the overall business. Unlike general accounting, which might not require such detailed breakdowns, IT firms need this insight to strategically allocate resources and refine service offerings, ensuring competitive advantage and optimized performance. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Upon incorporation, the initial capital raised from shareholders is recorded as a financial inflow, increasing the bank balance and establishing the company's equity base. This equity represents the ownership stake and is crucial for funding initial operations and investments. Purchasing computer equipment is an investment in the company's operational capabilities. It enhances the company's fixed assets and is essential for delivering IT services. The payment decreases the bank balance, but increases the asset value, reflecting the company's growing operational base. Hiring skilled technical staff ensures the smooth operation and delivery of IT services. The salary expense reflects the ongoing operational costs necessary to maintain the workforce. It represents a direct impact on cash flow, but is crucial for sustaining service quality and client satisfaction. Securing a service contract is vital for generating revenue and ensuring business growth. The contract value is recorded as accounts receivable, anticipating cash inflow. This transaction emphasizes the company's ability to convert human and capital resources into profitable engagements, underpinning financial sustainability. Receiving payment for services rendered is critical for maintaining liquidity and operational continuity. This transaction converts accounts receivable into cash, enhancing the company's cash flow position. Such cash inflows are essential for covering ongoing expenses and funding future initiatives, underscoring effective cash management. Paying rent is a necessary operating expense that ensures the company maintains its physical presence and operational environment. This expenditure reduces the cash balance, but is critical for sustaining a workspace conducive to productivity and client interaction, reinforcing the importance of ongoing operational commitments. Acquiring software licenses is a strategic investment that expands the company's service capabilities and technical offerings. This capital expenditure increases intangible assets and supports the company's competitive edge. Effective software tools are essential for providing high-quality IT services, which justifies the financial outlay. Interest payments on loans represent the cost of borrowing and are an integral part of financial management. This expense decreases cash reserves but is necessary for maintaining financial obligations and credit standing. Understanding interest implications helps in strategic planning and optimizing capital structure. Closing the accounting period involves transferring net income to retained earnings, reflecting the cumulative profit or loss. This process ensures accurate financial reporting and prepares the company's books for the next cycle. It highlights the period's financial performance and informs strategic decisions for future growth. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In IT services like TechWave Solutions, current assets such as accounts receivable and inventory rise as services are provided and products are prepared for sale. Liabilities like accounts payable and unearned revenue increase with obligations to suppliers and prepaid client contracts. This reflects the company's operational cycle and cash flow management, where anticipating accounts receivable collections helps maintain liquidity and meet short-term obligations. TechWave Solutions invests in non-current assets like property, equipment, and intangible assets such as software, which enhance long-term operational capacity. Equity accounts such as retained earnings and common stock reflect the company's growth and capital structure. Successful project outcomes increase retained earnings, showcasing profitability reinvested into the business, while common stock represents capital raised from investors, essential for strategic investments and expansion. In TechWave Solutions, service revenue increases with each project milestone reached, driving overall financial performance. Direct costs, including labor and materials, rise as these services are rendered, directly impacting gross profit. Understanding this relationship is crucial, as gross profit reflects operational efficiency and guides pricing strategies, helping ensure that service pricing covers costs and contributes to profitability goals. Operating expenses at TechWave Solutions, such as administrative and marketing costs, impact EBITDA, a key indicator of operating performance. EBITDA offers insight into earnings potential by excluding non-operational costs. Profit before tax further refines this view by considering depreciation and amortization, providing a clearer picture of taxable income. Analyzing these metrics helps management make informed decisions about cost control and investment in growth initiatives. TechWave Solutions' cash flow statement illustrates liquidity management. Operating activities generate cash from core business operations, crucial for maintaining cash reserves. Investing activities typically result in cash outflows due to asset acquisitions, essential for long-term growth. Financing activities show how the company funds its operations and investments through debt and equity, impacting financial structure and liquidity. Monitoring these flows ensures sustainable financial health. Key financial ratios offer crucial insights into TechWave Solutions' financial performance. The current ratio gauges liquidity, ensuring the company can meet short-term obligations. Return on equity provides a measure of profitability against shareholder equity, indicating how efficiently equity is used. The debt-to-equity ratio highlights financial leverage, essential for assessing risk. Lastly, the net profit margin reveals the efficiency of converting revenue into profit, guiding strategic decision-making. In this section, we'll explore common accounting errors specific to IT services companies like TechWave Solutions. Understanding these errors can help prevent financial misstatements and ensure compliance with accounting standards. We'll delve into issues such as audit findings, interview traps, ERP mistakes, and more, providing insight into how these errors occur and their impact on financial reporting. Audit findings of revenue misstatement in IT services can occur when revenue is recognized too early, often due to ambiguous contract terms with clients. For example, recognizing revenue before completing a software installation would prematurely boost earnings. Proper treatment involves adhering to revenue recognition standards like International Financial Reporting Standards 15, ensuring revenue is recognized only when performance obligations are met. Auditors detect these errors by examining contract terms and matching them against the service delivery timeline. During interviews at IT service firms like TechWave Solutions, candidates might overstate their accounting expertise, particularly with complex IT-specific standards. The pressure to secure a position can lead to embellished claims about handling advanced ERP systems or accounting software. This can result in incorrect accounting and financial mismanagement if hired. Correctly addressing this involves transparency and self-awareness about one's skill level. Employers can mitigate risks by using practical assessments during interviews to validate real expertise. ERP systems are vital for IT companies like TechWave Solutions, but data entry errors can distort financial information. These errors typically result from manual input mistakes due to insufficient training. For instance, entering a contract value incorrectly could skew revenue figures. To correct this, companies should adopt automated data entry processes where possible and conduct regular reconciliations to catch discrepancies early. Auditors usually uncover these errors during detailed transactional reviews and system audits. Cutoff errors in IT service companies occur when income or expenses cross into incorrect accounting periods, often due to a rushed closing process. For instance, recognizing December's service revenue in January can misstate both periods' financial outcomes. Proper accounting treatment requires aligning transactions with the correct period, typically using accrual accounting principles. Auditors identify these errors by reviewing the timing of recorded transactions against actual service delivery dates, ensuring accurate period reporting. Switching accounting standards from International Financial Reporting Standards to generally accepted accounting principles can be challenging for IT firms like TechWave Solutions, leading to errors in financial reporting. These errors occur due to differences in revenue recognition, asset valuation, and other principles, compounded by insufficient training on the new standards. Correctly understanding and applying the standards is crucial as it affects the accuracy of all financial statements. Auditors detect these errors by comparing the financial statements under both standards, ensuring consistency and compliance. IT service companies like TechWave Solutions often face ERP integration challenges, causing data silos and inconsistent financial reporting. Such issues arise from inadequate planning and lack of comprehensive testing before full system deployment. These errors can result in discrepancies between various departments' financial data, affecting decision-making. To address this, thorough integration testing and comprehensive staff training are essential before going live with a new system. Auditors would review integration protocols and system logs to detect these inconsistencies. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Capital expenditure refers to funds used by a company to acquire or upgrade physical assets such as hardware. It's recorded on the balance sheet. In contrast, revenue expenditure is the cost incurred for daily operations, like software subscriptions, reflected in the income statement. For instance, purchasing new servers is a capital expense, while paying for cloud services is a revenue expense. Deferred revenue occurs when payment is received before a service is delivered, common with annual software subscriptions. It's initially recorded as a liability on the balance sheet, then recognized as income over the service period. This ensures revenue recognition aligns with service delivery, promoting accurate financial reporting. For example, an annual subscription paid upfront in January is recognized monthly throughout the year. When software is purchased on credit, the entry involves debiting the asset account software and crediting accounts payable. This reflects an increase in company assets and liabilities. For instance, if TechWave Solutions buys software for $10,000 on credit, they debit software for $10,000 and credit accounts payable for $10,000. This correctly records the transaction, impacting both balance sheet accounts. Under International Financial Reporting Standards 15, revenue from multi-year contracts is recognized over time as services are delivered. This approach matches revenue with performance obligations. For TechWave Solutions, delivering quarterly software updates over 2 years might mean recognizing revenue each quarter as updates are deployed. This ensures that revenue reflects service delivery, providing a more accurate financial picture over the contract's duration. IAS 38 requires distinguishing between research and development phases. Research costs are expensed when incurred, while development costs can be capitalized if specific criteria are met, such as technical feasibility and intent to complete. For TechWave Solutions, expenses during initial stages are expensed, but costs from coding to testing might be capitalized, reflecting the value of the asset created. Cloud computing costs can be classified as either capital or operational expenses, depending on the nature of the expense. Subscription fees are typically operational, expensed as incurred. However, costs for setting up the cloud infrastructure may be capitalized if they meet asset recognition criteria. For example, TechWave Solutions may expense monthly cloud service fees while capitalizing initial setup costs to reflect their long-term use. SAP implementation costs are often divided between capital and operating expenses. Costs directly attributable to preparing the system for use, like customization and integration, can be capitalized as intangible assets. However, training and data conversion costs are usually expensed. For TechWave Solutions, ensuring accurate classification ensures financial statements reflect true asset values and operational expenses, aiding in strategic financial planning. Contract modifications under International Financial Reporting Standards 15 are treated depending on their nature. If the modification adds distinct services, it's treated as a separate contract. If not, the existing contract is adjusted. For TechWave Solutions, adding additional modules to a software contract may require treating the modification as a new contract, ensuring revenue recognition aligns with the revised obligations and service delivery. Goodwill in an acquisition is the excess of purchase consideration over the fair value of identifiable net assets. For IT firms like TechWave Solutions, this often reflects intangible assets like brand and customer relations. Consideration paid less the fair value of tangible assets and any identifiable intangible assets equals goodwill. This helps in recognizing the premium paid for expected future economic benefits not individually recognized. In IT services, ERP systems integrate modules like General Ledger, Accounts Receivable, and Accounts Payable to centralize financial data. This integration streamlines processes, enhances accuracy, and provides real-time insights. For TechWave solutions, an ERP system ensures cohesive financial management across departments, enabling seamless billing, expense tracking, and financial reporting, which is crucial for strategic decision-making and maintaining competitive advantage. TechWave Solutions operates with a keen focus on delivering tailored IT services. Their business model thrives on understanding client-specific needs, ensuring that their revenue streams are diverse with service contracts and software licensing. The project lifecycle includes key phases like planning and execution, where cost management is crucial. Quality assurance and client feedback loops are integral, reinforcing their commitment to both service excellence and continuous improvement. In TechWave's accounting, revenue recognition aligns with service delivery, ensuring compliance with international financial reporting standards. Deferred revenue is carefully managed, as payments are often received upfront. Project-specific expense tracking supports profitability analysis, while WIP entries capture ongoing project efforts. Equipment depreciation is a routine balance sheet entry, and accounts receivable track outstanding client payments. Additionally, software development costs for internal use are capitalized, reflecting long-term asset value. Prepare for interviews by understanding revenue recognition practices specific to IT services, such as when revenue is realized. Deferred revenue's impact on cash flow is crucial to explain, as is cost allocation for accurate financial reporting. Familiarity with key financial ratios will help you discuss company performance insights. Project accounting plays a pivotal role in IT, requiring keen tracking and reporting. Lastly, knowledge of international financial reporting standards and tech trends strengthens your industry relevance. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to Candy Mentor for more finance and accounting videos. We will see you in the next one.